Hello, everyone. Thanks for joining us today. My name is John Petrides. I'm a portfolio manager and managing director with Point View Wealth Management. I'm joined today by Point View's founder, president, and chief investment strategist, David Dietze. And this is a webinar of introduction to Point View Wealth Management. Point View was founded in 1993 by David Dietze, and we're based in Summit, New Jersey. So right now, I'd like to turn it over to David Dietze to begin the presentation. David?
Welcome, and thank you so much, John. Thank you for that kind introduction, and welcome to all of you here on the webinar. What we want to do is walk through a couple slides which talk about how we've been so successful over the last 25 years working with families, individuals, small institutions to reach their financial goals and objectives. Next page. So let's just kick this off with the first slide. Really, people say, well, you know, all sorts of people are offering to provide financial advice. What makes you and Point View different? Well, it's really quite simple. First of all, we are independent. We are not beholden to some mega financial institution which has their own mutual funds, which has investment bankers down the hall, which has all sorts of alternative financial operations, which often can cloud having the most independent judgment for people such as yourself, the consumers of securities. We are fee only, mind you. That's not fee based, which means we're compensated just one manner, which is a flat fee on assets under management. Why does that make so much sense in the world? Because it totally aligns your incentives with our incentives. This is as opposed to hide the ball where you really don't know what you're paying. You're buying expensive mutual funds, but it's all kind of buried within the mutual fund, or some sort of a transaction fee. If you have that sort of situation, what happens? You get an awful lot of transactions, I can assure you. We are fully registered with the SEC. Why is that so important? That means we are beholden to have by law the using the fiduciary standard that puts the client's interests first at all times. This is unlike many of the other financial institutions which have a lesser standard. So again, we're not selling products here. What we're trying to do is figure out exactly what the goals and objectives are for our clients and would-be clients. And then we design a customized portfolio that's going to help meet those objectives. But at the same time, we're bringing in our financial planning team headed up by Claire Toth. In many cases, it's more important whether you're using an IRA, a taxable account, some sort of a gifting strategy, concentrated stock. We're here to provide all those answers and overlay that type of planning on top of our customized portfolios. We have been successful over the last 25 years. We've been honored by CNBC to be in the top 100 independent fee-only advisors in the country. Just this season, earlier this month, Financial Advisor magazine recognized us also with being one of the top RIAs in the country. You know, managing private wealth, wealth owned by individuals, is not just how much money you make, but it's what you make after paying Uncle Sam. So at all times, we're using tax efficient methods. Also, transparency. It's important to know exactly what you own at all time. That's why we're big advocates. We'll talk a little bit more about this, about owning individual stocks and bonds. We don't want to just parcel out the investment aspect to a third-party manager, which has kind of an opaque fund, mutual fund, ETF, what have you, and you don't really know what they are doing. In terms of some of the details as to how we work with people, all of our clients' assets are custodied at Fidelity in their own name. In this post-Madoff, post-scandal world, that is so important to have the ultimate security for your assets. We work with people with a $500,000 relationship and up. Our fee is one flat 1% fee, which in many cases is less than what people are already paying with their mutual funds. And guess what? That not only covers that investment management, but it covers 24/7 financial planning. We do have a program where we can just prepare a comprehensive financial plan for our client for a flat fee. If at some point they want to take the next step and have us manage all or a portion of their assets, guess what? That fee is credited dollar for dollar against potential asset management fees. So, you know, fortunately, part of our success is really having the right team. And of course, here's a picture of our team. John Petrides, who made the introductions here, is in the upper upper right. Yours truly right there in the middle. Claire Toth, who heads up the financial planning, is between John and yours truly. Elaine Phipps and Donna St. Amant, portfolio managers on the right. And then the rest of our wonderful client service team, which include Jeanette Carey, Annette Tucker, Christina Gilmartin, and Marcela Garcia. So, why is this money management so important? Basically, it's inflation and longevity. Let's focus on life and life expectancy at this point. Most people, they say, gee, when they are 65 years old, they have to, kind of stop investing, hunker down in cash. The fact of the matter is, between you and a potential spouse, you've got a 90% chance when you're age 65 of going all the way to age 80. So you can't shut down growth. You can't ignore inflation. You've got a long way to go. And quite frankly, you've got a 50-50 chance of going all the way to 90, which would be another 25 years. So, reaching retirement land, no longer going to work does not mean you can let your money put its feet up on the table. You have to continue to invest to offset inflation and generate some growth. So, the circles put it all into perspective. We work with clients when they're those clients who are still working. We're trying to create an asset management strategy which provides for growth so that they can get to the right number so that they can kick back if they so choose. Help them, of course, with their career and cash management, working at all times with them to keep the tax man or tax woman at bay, and so that they have the most after-tax savings from their salary and other earnings. That takes them through up to retirement. And at that point, we're crafting a portfolio that not only can grow, but it can also generate regular income. So many of our clients have us transfer a set amount on a set day each month into their local bank account. So it's, we're creating like the successor to their paycheck. And so we're managing for growth, but also capital preservation. And through our planning, we're making sure that monthly distribution from their investment portfolio dovetails nicely with whatever pension and social security they may have. At this point, they may want to be ramping up charitable intentions. And again, we're there with them every step of the way as to how, on a tax advantage basis, they can execute on those charitable intentions. And of course, at that point, they're going to have kids that are perhaps out of the nest. They may be so lucky as to have grandkids. Those, younger members of the family, they have financial needs too. In many cases, they want to be saving for college. We're going through all the various avenues that one can on a tax efficient method generate long-term savings so that the next generation can go to college. That can include 529s. And also, we're helping the next generation. They may have their first job, be confronted with a set of employer retirement plans, how to pick through them, how to come up with the best strategies to get the best start going on with their investment careers. It's really a twofold attack here. One is the investment team is working on the management. As I mentioned, we avoid, for the most part, any kind of funds and third-party managers. We're creating a customized portfolio of stocks and bonds. Of course, job one is always to minimize risk. So at all times, we're staying extremely diversified. No big bets in any one sector. No big bets in any one credit aspect. Part of the reason one of the ways to be successful is to keep the costs down. So at all times, we're avoiding expensive third-party products like mutual funds. At all times, we're managing the portfolio. So at the end of the day, there's no ugly tax surprise. And so we're promoting the tax efficiency. We're looking at these portfolios monthly. We're rebalancing. We're looking for opportunities. We're giving feedback to our client. And of course, we want that dialogue to be two ways. We want us to be the first people that they're going to consult with for anything in their financial lives. At all times, we're doing the investment management here. We're never outsourcing that most important task. Over on the financial planning side of things, we're looking at what the cash flow projections might look like in retirement, expenses going out, income coming in, how to best save on your taxes in that connection. As I mentioned, gifting techniques so that you can give back to your community, but always in a tax efficient management in a tax efficient manner, and also doing that in a way that makes sense given your overall financial situation, making sure that the next generation, maybe the 2 generations after that, the grandkids have a college funding strategy in place. Many of our clients, of course, work in technology and healthcare. They're paid in large part through stock options and other employer stock compensation. How best to exercise that, to capitalize that, both from an investment strategy point of view, but also minimizing the bite of the tax person. And of course, restricted stock is also part of the puzzle for those who are working in the high-tech area and getting a lot of employer stock as part of their compensation. One of our hallmarks, as I mentioned, most people, our competitors, they're saying, gee, we'll manage your money. And basically, they hand off the job to a bunch of funds. We see people with 20 different mutual funds. We do the hard analysis. We do the x-ray of the funds. Guess what? 13 of the funds own, let's say, Apple computer stock. So you can be sure one fund is selling Apple the same day another fund is buying Apple. That's expensive. That's not efficient. That's just a diluted mess, really. Again, it's so important to be in control of when you turn over positions in the portfolio, because when the trading occurs, that's when the taxes are collected. We don't want the funds to be in control of that. We want to be in control of that in consultation with our clients' best interests. We always want to know what we own. So many of the times with the funds, you call them up, say, what's my top 10 holdings? Well, as of November 30th, here's what it is. Well, what is it today here in July? We can't tell you that. Is the team still in place today in July as it was in the last 5 years? Well, we can't tell you who's been on the team, who's not on the team. So we just feel that that's a second-rate way to go about managing a significant nest egg. ETFs, it's the same thing. Do we ever make exceptions? Sure. For closed-end funds where we can buy a good mutual fund at a double-digit percentage discount from net asset value, that can be attractive in certain situations. Bottom line, we try and develop for our clients their own customized mutual fund by assembling the building blocks and creating that in their own portfolio and not just pushing them into a non-customized third-party product. All of our portfolios contain some fixed income. Why is that so important? People say, well, won't stocks make more money? Well, I don't need bonds. They're just going to hold me back. Well, you just never know what's around the corner. And historically, periodically, there are corrections, there are sell-offs, there are even bear markets. And bonds provide that insurance in your portfolio. I'd love to be able to say for myself, gee, I don't need to buy car insurance for the next 12 months, but you just never know. It's good to have it in case the unthinkable happens. And you can see from this chart that the blue columns show years where stocks sold off and the percentage they sold off. The green shows the performance of bonds during that same year. And you can see typically when stocks sell off, bonds go in the other direction. So what we want to do is create portfolios when we have an ugly zig in the stock market, the bonds zag in the opposite direction, giving you a smoother ride. We're here to help people in the community or people outside the community. We want to learn about what your financial goals are, help you develop what you might need in retirement, review your current accounts, whatever you're doing now, to see, are you well positioned for growth? Are you positioned for income? Does the current portfolio link up with the type of retirement, the type of financial legacy you want to achieve? And then, of course, we're looking at exactly what you're holding now and just trying to determine whether that's best for you. Many people think annuities is the answer. The fact of the matter is annuities are complicated, illiquid, expensive, and then perhaps when you pass away, there's nothing left for the next generation. We're also looking at your retirement plans. Most people have one that was established when they were in the workforce, or if they're currently working, they switch jobs, they leave the workforce, and they leave that money behind them. That makes no sense at all. You want to roll that out into an IRA so that you have lower costs, more choices, and you can better customize it with the rest of your financial life. Bottom line is we want to make sure that your investments are working as hard as you did when you were actually working for a living or still working for a living. On financial planning, we want to know, do you have enough? How is it going to work year by year going forward, given potential returns from your portfolio, given the outlook for inflation? And that's why we do a column by column assessment of each year going forward for the projected rest of your life to see whether income and expenditures are in sync. What if the unthinkable happens? Do you have some liquid resources that can take care of that? If you have kids or grandkids to put through college, are you setting aside an appropriate small bucket within your nest egg that on a tax efficient manner is targeted to grow in order to fulfill those costs down the road?
David, does Point View offer estate planning services?
So, we are not a law firm here. We do not write wills. We're not an accounting firm. We don't fill out tax returns, but we do everything short of actually scrivening the document. We provide the strategy. We outline what the goals might be and what the best legal avenues are to reach those objectives. We are so lucky to have heading up our financial planning, Claire Toth, who is a tax attorney, in fact, spent 12 years in the belly of the beast. That would be the IRS in Washington, D.C. So she is fully equipped to provide adult supervision so that you can create an estate plan that's going to meet your goals. And then when it comes time to put pen to paper, as it were, we can work closely with your estate planning attorney to make sure that the strategy that we've discussed is actually implemented.
Here's another very good question. Why does Point View choose to invest in individual stocks and bonds?
Yeah, great question. It's really 4 reasons. One is save money. We charge a fee. The mutual fund charge a fee. That starts to add up. We want to get rid of one layer of fees. Second, tax efficiency. We want to be in charge of any turnover or trading in the account so that we can postpone the day of reckoning with Uncle Sam and whoever runs your state. And we can't do that in a mutual fund where we're not in control of turnover. Third, we want some sort of focus. We like diversification, but not excessive diversification. Each fund typically has anywhere from 50 to 1,000 stocks. You got 10 mutual funds, and pretty soon you're over diversified. There is no focus. And finally, transparency. We always want to know what we're exposed to, what we own, and we just can't do that in the opaque world of mutual funds. Does that mean we never own a mutual fund? No, that's not true. There's always a sliver in people's portfolio of no load, inexpensive bond index funds, which gives us extra liquidity to honor a withdrawal request, to take advantage of an opportunity. But by and large, we stick with the building blocks. We don't outsource the money management to third parties.
David, here's another question regarding financial planning. So this person's asking, do I get billed by the hour for financial planning services?
Absolutely not. As a former attorney, I know what that's like. And, people never want to call you because they're afraid of watching that clock tick and generating more fees. They don't know where that's leading to. If we try, as a lawyer, if we tried to call a client, they didn't want to pick up the phone because they knew that the clock was going to start. So for our low all-in fee, there's unlimited meetings, unlimited phone calls, emails, and attention, so that you always know exactly what it's going to cost, and we never feel the pressure of the clock to either short circuit the job or people feel that we're going to overcharge them. So no, we avoid that kind of a by the hour system.
Here's a 3-part question from one individual. And you basically touched on this a little bit just now. How often do you consult with your clients to review their objectives? If someone leaves the state of New Jersey, is that a problem from a communication standpoint? And the third person, the question this person asks is, they saw you on Bloomberg TV, you did a great job, and are you still playing tennis?
Well, there's many parts to all those questions. So, basically, we are constantly available to consult with clients to review objectives. We find what works best is on a monthly basis to roll up our sleeves, look at everything that the client is doing in their portfolios, engage in a discussion, report with the client as to what's going on, and try and get some feedback. So we think that monthly we should assess everything. Then perhaps quarterly, perhaps annually, we encourage a sit-down meeting. We've got a great conference room. The coffee is always on. We want to sit down with the client and meet. Of course, we got clients across the United States. We can do a Skype or other type of visual phone call if that is appropriate. As a result, we work with people not just in the New York metropolitan area, but really people across the country. Indeed, we have someone in the State Department that we're working with us in Beijing. Don't tell anyone that, of course. So it's not a problem if people move about. The focus is always on, the relationship, and that can be done no matter where people are. Yes, we are, both of us, John Petrides and yours truly, do make regular media appearances on CNBC and Fox and Bloomberg, and try and keep our viewers and audience abreast of the latest developments that way. And we were on Bloomberg yesterday.
Does your firm offer to sell annuities and/or life insurance?
Sure. So, basically, we feel strongly that we should keep fees to a minimum, not use third-party products, invest for growth, make sure there's going to be something left for the next generation. And so for all those reasons, things like annuities are not things that we recommend. Having said that, we understand people are always looking at annuities. They may own annuities. And so the beauty is that we have the experience and tools to analyze exactly what they own and look at the pros and cons, but we can do it in a more objective manner because we're not also saying, gee, if you like this car, we can sell it to you. So we can advise on annuities. We don't sell them, and we don't normally think that is a great opportunity. Insurance can make sense. The ideal situation is someone just starting in the workforce with many dependents, perhaps a non-working spouse. Then you're going to want to have some insurance. But because of the fact that we don't sell that type of insurance, we can objectively help ascertain how much insurance should be procured and what are the best sources for that.
So typically with an investment portfolio, how many positions do you like to create when you're customizing the portfolio for clients?
Well, at all times we want to be diversified, but we want to have focus. So, you have one stock, there's no diversification at all. You have two stocks, you're diversified by half, three stocks, and so forth. Typically, at the end of the day, we're looking for a portfolio that has between 40 to 50 stocks so that we have focus, but we can keep track of it all, and all the positions are meaningful so that when we're successful, it can have a meaningful influence on the portfolio. But if there's a hiccup in the road, it's a ding and not a wipeout in terms of someone's portfolio and or retirement.
What's Point View's preferred minimum investment amount?
$500,000. So we never ask to work with a client's entire portfolio, but $500,000 is our preferred minimum. And of course, we have people here that are at that amount and go up towards $10 million.
And David, is that $500,000 just for one single account, or is for the family relationship?
Great question. So most families, they have a series of accounts. They may have a joint account with the spouse. Each spouse may have an IRA. There may be some accounts set up for the kids for their college. So we aggregate together all of those various accounts to get us to that $500,000 minimum. Not each account must have $500,000.
Thanks, David. Great job. You can take a breath now. Thanks, everyone, for joining us. As David said, this is how you could find out more information. We'd love to hear more from you and learn more about your situation. And again, thank you for your time.
Thank you so much. Thank you, John.
Sure.